Welcome to Every Dollar Counts with Josh and Jay, a weekly shot of true serum for your investments and insurance questions. I'm Josh Null, the owner of Gulf Coast Financial Advisors. I'm joined today by Mr. Jay Stubbs, Regional Director for First Protective Insurance Group. We are brought to you on the Prime Capital Investment Advisors Podcast Network. Today, Jay and I have two very special guests from Prime Capital, CEO Glenn Spencer and President and owner Tim Hakes. If you're an investor, you will definitely want to listen up. We're going to talk about the secrets of the high net worth investor and the services that Prime Capital offers to these investors. But before we dive into this, let's have our friends from local band, Sloth Racer, kick us off. Glenn, Tim, welcome to the show.
Thanks, Josh.
Before we get started, I'd like to make an announcement to our listeners, so this will kind of make sense while you all are on the show. My company, Gulf Coast Financial Advisors, is now officially part of the Prime Capital Investment Advisors Network. That's a lot of vowels. Prime Capital is one of the largest independent investment corporations in America. And with our branch location, I think officially 18 locations. Does that sound right?
That's close.
That's close. Yeah, it's close enough, right, for clients. Spread all across the U.S. It's a total game changer for my company and for the Gulf Coast area we serve. But enough about me. What we want to do is dive in with Glenn and Tim, and let's give our listeners a brief description of the services that Prime Capital offers.
Thanks, Josh. Prime Capital Investment Advisors basically operates under three brands. Prime Capital Wealth Management, which really works with high net worth investors and individuals. Qualified Plan Advisors is the second brand that we're building, and that firm consults with businesses from 100 employees to 10,000, 15,000 employees, helps them design their retirement plans, primarily 401ks, 403b plans. And then our third brand is called Financial Fitness for Life. And Financial Fitness for Life basically provides retirement plan participants with education services around not only their retirement plan, but overall financial advice in their lives, and also performs asset management services. So Prime Capital Wealth Management works with individuals, qualified plan advisors, businesses, and then Financial Fitness for Life, those plan participants in retirement plans.
Perfect. Jay, how are you?
Josh, I'm good. It's good to be with you. It's good to be here for your transition. It's good to meet these guys, Glenn and Tim. Thanks so much for making the effort to come down to this beautiful part of the country, but really kind of hot part of the country. I'm sure you guys are experiencing a little bit of the heat wave too, but the humidity and heat's been pretty rough on us down here. So welcome.
Well, thanks for having us.
And I know you guys have a number of locations. As Josh and the listeners know, the firm that I do business with is primarily a risk management firm. And you've got a number of locations around the country and a bunch of advisors. I'm interested to know, do you have some of those advisors that are doing a comprehensive financial plan approach? It's sort of a CFP model.
Yeah, absolutely. We think that financial planning is obviously the wave of the future in the industry. And so we have wholeheartedly embraced full circle financial planning. Matter of fact, we're in the job market right now to hire a chief financial planner for our headquarters for our Overland Park location. We've been integrating that into our practice for quite some time now.
I'm experienced in that world because I do work with a lot of different CFPs and other advisors who uncover risk management. So I was curious to know. So that's a good thing, Josh. When you've got a firm who understands that the future is comprehensive planning, it's part of the dynamic of what people are looking for. I don't know if it's necessarily a secret of the investor world, but right. For those that are listening to this, if you are in a situation where you need more than one question answered in more than one topic, you might need a comprehensive approach.
Well, Jay, we called this podcast episode Secrets of the High Net Worth Investor, right? But it was meant to be a little tongue-in-cheek because I'm going to go to Tim here. There's really no true secrets to investing and accumulating wealth. Instead, there's systems and processes that investors can access and use to potentially accelerate the creation and protection of wealth. So I'm going to go to you, Tim, because you've got probably one of the longest careers in wealth building with your clients. What have you seen, not necessarily secrets, but what have you seen your wealthy clients do that maybe the average investor doesn't do as well or doesn't do?
The thing about it is there is no average investor. I joke around all the time and I say it's impossible to give investment advice to a room full of people because everybody's different. And so it kind of goes full circle on what Jay mentioned earlier, and the financial planning is a key component to that, because most folks, what they've done, even, I don't care if you're high net worth or wherever you're at on the scale as far as the number of assets that you have, everybody needs some kind of a plan, okay? And so most of the time, these folks will come in and they'll have things spread out everywhere. Maybe they have an old 401k plan. Maybe they have, multiple bank accounts. And so what we're trying to do in that financial plan is gather all that information, almost make like a personal balance sheet for them. And we don't, oftentimes in the first several meetings, we don't even give financial advice. We're just gathering data from those folks so that we can go back and process it and at some point start to give them advice and direction on how to allocate the funds. So I think the number one thing is you got to know where you're at now and where you want to go, which is really the purpose of the plan. So where's the finish line? How are you going to get there? And then we backfill that with the particular products and services that we have to offer.
So what you just said there was pretty boring. Right, pretty straightforward. You didn't.
Thanks, Josh. Appreciate that.
You didn't say you're going to put Bitcoin in their portfolio or anything.
No, most of the people that we invest with, not most of them, all of them, they're not really too concerned about trying to hit a home run. They're trying to prevent themselves from becoming poor. Would be a better way to phrase that. Right,
because a lot of times, even now, I'll have people approach me, and I guarantee they approach you on, hey, what's something I can do that's going to really get me ahead, and is kind of something that maybe the general public doesn't know. And I tell them a lot of what you need to do is just repetition, right?
Discipline. I'd say one of the big things is tune out. The whatever the headline of the day is. You've had a lot of people that they lived through this 2008, 2009 recession. So whether they're investors at that time, they either lost money or they knew somebody that lost money. The folks that rode that out, they turned out just fine. It wasn't pretty. I mean, it took a couple of years for them to get back out of however much they lost. But I tell you what, those people that were disciplined and make sure that they're in the correct asset allocation of the correct type of investments based on their risk tolerance. And that's why I say you can't give investment advice to a room full of people because, you could have 3 40-year-olds in the room. One person could be scared to death and want everything and guaranteed. The other person could want to light their hair on fire and invest in the most aggressive things. So it's not just age. It's personality. It's the type of experiences that they've had in the past in investing that will drive them. So what we try to do, one of the big things in the planning process is to make sure that that particular person is in the right mix of investments based on what's best for them.
Guys, I attended and was part of a conference for the Financial Planning Association last week down in Destin, Florida. And the Gulf States chapter hosted a number of different speakers, one of whom spoke on the behavioral finance, market behavior, and really having to coach your clients on situations that are going on in the marketplace today. We're on a 10, nearly 11-year bull run. Most of the people who have accumulated their wealth over the last 10 or so years haven't seen a dot-com recession or they haven't seen an 08-09 recession because they got into the investment world. What would you say is some of the things, Glenn, that you could coach an advisor, coach a client on, okay, we've had a good run. What's coming up here in the next few years? Are there any things that we need to be aware of? Do we need to take some gains off the table? So somebody who's been in the market, done well for the last 10 years, what do they need to be thinking about?
I wouldn't really jump into any specific strategies. I would echo what Tim said. He used the word discipline. The 2 words I wrote down as Josh was given the introduction were consistency and discipline. So I would find an advisor that you trust. It's interesting when Josh was telling me about this topic and he said, what is the high net worth investor looking for? The very first thing I wrote down was trust. Most investors out there aren't experts in investing. They have accumulated assets because they're passionate about doing something else. Building their company, spending time with their families, spending time in their business communities. They're passionate about something else, and as a result, they've accumulated these assets. And they really need an expert like Tim or like Josh to help them along the way. And Tim said it earlier, but the thing that a good financial advisor will do is prevent them from making big mistakes.
Like selling when the market's down and buying when it's at its peak?
Hey, you don't need to be a genius to say, buy low and sell high. The trick is doing it, right?
Right. Jay, I meant to share this with you the other day. We have down here, and probably most areas, but especially down here in lower Alabama, we have a couple of attorneys that are really big on billboard advertising. And I think you know some of the ones I'm referring to.
Yeah, yeah.
And they put their verdict, I won so much million on for a client and all that. And I was driving down to Orange Beach the other day, and one of the billboards said, I got my client $3 million, right? So I got a question to you all. I don't want to say average investor. I think you're right. But a lot of people, if they had $3 million sitting in an account, they feel pretty comfortable. Is that fair to say, Tim?
Well, it's all based on their income needs. I mean,
Right.
it's all relative to whatever your lifestyle is.
Well, my point being is, we can't project the future, but we can look at historical returns, and we could probably back into some math where a person could accumulate $3 million and not get hit by a truck. Is that fair?
Absolutely. Yeah. Well, I would hope not. Yeah. I hope so. I mean,
Yeah, but the point of that is a lot of times people are looking for the quick hit,
yeah,
right?
it doesn't really exist in the investment world, and usually the risk isn't worth whatever the potential reward could
Win
be.
the lottery, get hit by a truck.
No, most people have accumulated wealth. They've done it over a period of time from business owners, high income earners, whatever it may be. It depends on how you define high net worth as well. Everyone's got a different number.
Right.
If there was anything that you would tell a client on, okay, I've just had an inheritance come in. Maybe they've had a parent pass away. Maybe they had a windfall of some sort,
Or got hit by a truck.
or got hit by a truck. Maybe their spouse got hit by it. Yeah, something has happened where they've come into money. What's one of the first things you want to coach somebody to do?
Well, what you want to tell them is it goes back to that planning process that we talked about earlier. But really, everything's driven by what income that they need off of the investment. So when someone comes into a piece of money, whether it's retirement or they hit by a truck, like Josh is convinced if you get hit by a truck, that's a good retirement plan, I think. But if you come into that, really, what you want to teach them is you want to teach them that when you go to retire, you don't retire off of the lump sum. You retire off the income that the lump sum produces. Okay. But people look at numbers on a page, and I always joke and I say, if somebody sent you an invoice in the mail that had the value of your house on it every month, it would go up and down. You'd probably be nervous about the value of your house. Well, the problem with investing is that you can check it every day, right? That's almost a bad thing that you can check it so often. So you're looking at it month to month, quarter to quarter, hopefully not day to day, but you're looking at it over these periods of time when really at the end of the day, you need to have a long-term time horizon to accomplish that. And there are no good get-rich-quick schemes that I've seen that have worked effectively in any type of manner.
Right.
One thing I would add to what Tim said is you mentioned, Jay, you get this big asset, you inherit the money, or you get this big asset at some point. Like, I would encourage you to think around that. Hey, what's your long-term goal? Understand your own risk tolerance. It's pretty easy for a good financial advisor to walk you through a series of questions that'll get you to what's your risk tolerance. To Tim's point, how are you going to feel when you see your statement and it's fluctuating up and down? The investment professional knows that volatility actually creates greater long-term returns, but most investors can't live with that volatility. So understand your risk tolerance, understand where you're trying to get long-term, and I think that'll make you feel more comfortable as an individual with whatever strategy you develop, because there's not a strategy. It's all predicated on the individual. So
if you're listening and you're a 30 or a 40-something, your goals and objectives may be completely different with regard to that asset than somebody who may come into that asset when they're 60 or 70. They may say, I want to make this part of my overall retirement plan so I make sure I don't outlive my money.
And it's interesting, the demographic that you raised, and I'm not making any sweeping generalizations, but that person who is 27 to 30 years old right now is among the most conservative investors out there because they've seen their parents go through the Great Recession. So it's a great example of where people naturally think that young investors want to be more aggressive. It's actually not true. And putting them in aggressive investments is probably the opposite of what financial advisors should be doing.
Good advice.
I think what most of the people that I deal with, what they're looking for, and Glenn hit the nail on the head before, he mentioned trust. And really what people want, and what we want, is we want long-term relationships. That's the one thing that we're looking for. And we can't be successful in this business if we can't attract and retain clients. And in order to do that, you have to develop a relationship. And so that is probably the most important thing, because things are going to go wrong. If you're investing with someone for 10, 20, 30 years, they're not all, I mean, I'm not saying you lose all your money or anything like that, but you'll invest in maybe one or two things that didn't go as well as you wanted to. If you've got a good relationship there and everybody knows that there's common interests involved on both sides, then generally speaking, you can work through those things.
Do you find what you're leading to, I think, is diversification? Is that a fair point on what you're saying? You'll have some winners and you'll have some losers.
Absolutely.
Right. Do you find with your high net worth investors, does diversification rules stay the same? Do things change as they move up the investment chain?
I think their diversification rules are always in play, but it just boils down to that particular individual investor and what's best for him or her at that point. Generally, when people get a little bit older, depending on their definition of older, but I would say when people get in their 70s and 80s, a lot of times you'll have the dollars invested much more conservatively.
Right. Well, Jay, I'll say this. I'm going to turn it back to you. Jay and I we've made this statement before, but I don't know if you remember when your grandma and grandpa retired. So I'll just, from my standpoint, my grandma and grandpa retired in their mid-60s. I don't mean to pick on them, and obviously I was a kid, but they were old, right? I mean, they were beaten down. They were a little beat up. Didn't seem like they'd have a long time ahead of them. I use it as a contrast to my mom, who is now 66 years old and running marathons, right? So her outlook on her money, in my opinion, is a little different than maybe what the previous generation was. So do you feel, the point of this question or the statement is, have you noticed in your long career that longevity question becoming more and more prevalent? A lot of times I remember when I was young, people say, well, I'm going to drop dead when I'm 70. And that's just not the case anymore.
Yeah, you would hope not, but definitely. I mean, you always ask the questions and try to determine what their family history is and things of that nature, but that's never a guarantee either. Most of the planning that we do, we're planning to age 95 or age 100, or a lot of times the client will tell you to plan to this particular age.
Longevity, it's interesting that you raised that issue, Josh, because longevity is the biggest unknown variable in a financial plan. I heard recently that if you retire at age 65, which is early nowadays, your life expectancy is 85. However, the likelihood that you live to 92 or 67 is approximately the same. So that range of possibilities is really what creates a lot of uncertainty in a financial plan.
Right.
And gone are the days of hitting the birdie on the 18th green and dying of a heart attack. They're going to resuscitate you, and they're going to get you back up and on your feet and enjoying your life. The point I'm trying to make there, guys, is medical technology is helping us all outlive things that used to be the death knell. The cancers, the strokes, the diabetes, the cardiac issues. People are in a situation where they're going to survive and thrive longer than, Josh, your grandparents in a situation like that. So we do see a lot of risk management in my side of the world, and on your side of the world is the advising of how do we position and structure these assets, your portfolio, to make sure that the income base is going to be there as you approach your 80s and your 90s and maybe even into your triple-digit ages.
Very good. Well, let's jump to the other end of the time horizon. We've been talking about longevity and getting older and retirement, but you also have folks that are young professionals, maybe coming out of medical school, maybe inheriting a business, and now they're dealing with larger sums of money than maybe what they were used to before, right? So I know we can't give specific advice, not that I'm asking for that, but when you have someone come in that is for the first time, you went through this yourself, Tim. You come up and you start hitting your stride in your career at a young age. What are some things, some general rules for somebody like that to help them where they look back 20, 30 years from now, they're going to be further along than maybe they would have been otherwise?
Yeah, I think someone said it earlier, but don't make the big mistakes, and so you can take the fun money down at the casino and have fun on a Saturday night at the blackjack table or whatever, but you generally don't want to do that with your investment portfolio. It's really all about sitting down, and doing the math and saying, if I have X amount of dollars now at a particular rate of return over so many years, I accumulate that number that I need to then turn around and take the income stream back off of it. Right. You've got to show them what they need and how to get there. It's kind of a roadmap.
It's interesting. My father-in-law told me something when I was 22 years old, and I was a finance major, but he said, Glenn, pay yourself first. And I said, what does that mean? And it meant to save your money first. Everybody's read the statistics, but if you saved an amount of money from 22 years old to your early 30s, and then you stopped saving, and you compared that to the person who didn't start until their 30s and they saved until they were 65, you'll have approximately the same amount of money. There's a couple of lessons in there. One, if you consistently save over time, you're way better off saving 10, 12% of your income than getting 6.7 versus 6.6% earnings on that money over time. So pay yourself first, save an adequate amount of money long term, you'll be happier.
So I can't just marry rich?
You cannot.
That'd be a better solution.
That was always my plan, and somehow Jen and I both blew it. So, all right. Anything else we want to touch on before we start wrapping up?
Well, one other thing, there's somebody mentioned Bitcoin earlier in this conversation. I don't know who it was.
Well, I did that in a smart alecky way. I want to be fair. Let me explain myself. There's blockchain and all that, right? I was trying to throw something out there that someone would recognize.
The question I have is, somebody is getting pitched somewhere today, either by phone or through social media. They're watching a video on Facebook or LinkedIn or Instagram, and they're hearing about a quick, rich scheme. Talk to us about some of the things that people need to be aware of, that you just can't really, trust everything you see and you hear, but you do need to have a good approach. But there really is the whole discussion of a quick hit. Like you said, just be wary and cautious of it.
If it's too good to be true, the old saying, right?
Well, they just shut down, I don't have specifics, but the FTC just shut down one of those shows that were having these seminars on getting rich quick in real estate. And they were teaching people how to flip houses. Have you heard about this?
I didn't hear the ones that got shut down.
Yeah, it got shut down this past week. And the issue was, among multiple issues, they were having these people come in that would not have lines of credit or access to capital, and they were having them open up credit cards to finance these real estate transactions.
Ouch.
With the promise of getting rich, right? And
Scary.
So part of what Jay and I do with this show is, just like you did earlier, and I was teasing you about it was a boring answer. I was trying to make a point, is this stuff really comes down to habits, persistence, time, budgeting, all these words that your mom or your grandma or somebody in your life would have tried to teach you, right? But that is the secret. Is that fair?
Absolutely. And discipline, the word that Glenn and I have been throwing out.
Right.
There are plenty of stories out there on people that got rich overnight. The thing that I would offer is it's probably not a replicable strategy. And so, we're going to read about people throughout our lives that have gotten rich overnight flipping real estate or investing in Bitcoin. A lot of people made a lot of money in Bitcoin. It's not a replicable long-term strategy. And so for the average person out there that's listening to this, they want consistency. They want to get a good return. They want to get a good result over time. And consistency and discipline is the answer.
Well, I got one more note on that. So, Tim, specifically for you, what Glenn just said, have you had over your career where folks have been really disciplined about building their nest egg, and in doing so in a disciplined manner, it's allowed them to take other chances outside of their wealth creation? It's given them freedom?
Well, I think it's all relative to what's suitable for that particular person. there's been a lot of people I've worked with for 20, 25 years that I started working with them in their 50s and built the plan and got them to retirement, and then, now we're doing generational planning for their kids and things of that nature. But some people will, most of the time, like Glenn said earlier, they've made their wealth from doing something else. It was like their business, or they sold some real estate, or however they accumulated their wealth. So oftentimes people will usually dabble in whatever they're comfortable in.
Understood.
That's what I've found.
Jay, you got anything else?
Kind of. I'm on the protection side of things. So just keep that in mind. When somebody is reviewing their overall financial situation, I always try to make it a point, hey, make sure you've got the right insurance coverages in place. Take care of your family. If in the unforeseen premature death occurs, make sure you're protecting your income in the event that you cannot work for an extended period of time, that disability income. And then make sure that as you age and get towards your retirement years, that you have a plan in place to protect the wealth that you've created over your lifetime, so that it doesn't erode away because you've had some significant long-term care event, and you've got to have others take care of you either at your home or in a facility. So there's risk management components. We didn't dive into that too greatly today, but as people grow and amass their wealth, they need to also make sure that they're building a fence around that wealth.
Very good. Well, I've got a couple things to say before we wrap it up. One, Glenn, Tim, thank you all for coming down, flying down here, being part of this podcast in person. That was awesome. Thank you.
Thank you for having us.
And also, I'm very excited. You guys are twins.
I know it.
I'm also very excited that my company, Gulf Coast Financial Advisors, is going to have the power of Prime Capital Investment Advisors behind us. All right, we got some.
Very excited for that, Josh.
Yeah, we're gonna do some neat things here on the Gulf Coast, right?
Absolutely.
Okay. Well, with all that said, I think that's it, unless you got anything else.
I'm good. Guys, enjoyed it. Hopefully we can continue this working relationship forward and help these clients down here on the Gulf Coast.
We look forward to it.
Perfect. All right. So another show in the can. I want to first thank again Prime Capital Investment Advisors executives Glenn Spencer and Tim Hakes for joining us today down here in Mobile, Alabama. Also, many thanks to our producer, Johnny Gwynn, Deep Fried Studios, and of course to my co-host, Jay Stubbs. And a huge shout out to all you out there that have joined Jay and I on this journey, and to those of you that are joining us now. Got a question for the show? Reach out to us. You'll find a link in the show notes to contact us. If you like the show, do me a favor, please subscribe on the Apple Podcast app or wherever you find your favorite podcasts. And while you're there, you would be doing us a huge favor if you would rate and review the show. It helps other listeners like you find us. Lastly, you like the show music? Go check out slothracerband.com. That's slothracerband.com. And they're going to take us home now. This has been Every Dollar Counts with Josh and Jay. Advisory services offered through Prime Capital Investment Advisors, LLC, PCIA, a federally registered investment advisor. PCIA, doing business as Prime Capital Wealth Management, PCWM, and Qualified Plan Advisors, QPA. Securities offered through Private Client Services, PCS, member FINRA, and SIPC. Gulf Coast Financial Advisors is independent of Prime Capital Advisors. Information presented is for educational purposes only, is not an offer or solicitation for the sale or purchase of any securities. All investments involve risk, and unless otherwise stated, be sure to consult a tax professional before implementing any tax or investment strategies.